For decades, Japan lived inside an economic paradox. It built one of the largest debt piles in human history, yet paid almost nothing to borrow. Its central bank flooded markets with money, bought government bonds by the trillions, and pinned interest rates near zero while the rest of the world moved on. Investors came to see Japan not as a risk but as a utility, a permanent source of cheap capital, a financial constant, and then, quietly, that constant began to move. Japan's government bond market worth roughly $8 trillion started to wake up. Yields crept higher, bond prices slipped. And for the first time in years, the Bank of Japan signaled something unthinkable during the era of free money. It would tolerate volatility. It would step back unless panic erupted. That single shift raises a dangerous question: if the cheapest source of funding in the world stops being cheap, who pays the bill? And how does a change inside Japan's bond market ripple outward into US stocks, Asian currencies, government budgets, and the everyday cost of living for millions of ordinary people? To understand why this matters now, we need to step far back into the economic trauma that shaped modern Japan. In the late 1980s, Japan experienced one of the greatest asset bubbles in history. Tokyo land prices soared so high that, at the peak, the land beneath the imperial palace was said to be worth more than all the real estate in California. Stocks followed, credit expanded rapidly. Wealth felt permanent. Then the bubble burst by the early 1990s. Asset prices collapsed. Banks were left with bad loans. Companies stopped investing. Households stopped spending. What followed was not a dramatic crash but something far more insidious. Stagnation. Growth slowed. Prices fell. Wages stagnated. Confidence evaporated. Japan entered what became known as the lost decade, then another, and another. In response, policymakers made a fateful choice. Instead of allowing widespread bankruptcies and painful restructuring, they tried to cushion the system. Interest rates were cut to zero. Fiscal spending expanded. Public debt ballooned. And when zero rates were no longer enough, Japan pioneered something radical: quantitative easing. The Bank of Japan began buying government bonds at an unprecedented scale. Eventually, it went further, introducing yield curve control, or YCC, under this policy. The central bank didn't just influence rates. It dictated them. The BOJ promised to cap long-term bond yields at around 0%. Buying unlimited bonds if necessary to enforce that ceiling. For markets, the message was clear. Volatility would be suppressed. Bond prices would be protected. Japan's government debt, despite reaching more than 250% of GDP, would remain safe. This decision reshaped global finance, with yields at home crushed. Japanese banks, insurers, and pension funds searched abroad for returns. So did hedge funds and global investors who discovered a powerful trade: borrowing yen at near zero cost, then invest in high-yielding assets elsewhere. This became known as the yen carry trade. For years, it fueled demand for US treasuries, corporate bonds, emerging market debt, real estate, and stocks. Japan quietly became one of the world's largest exporters of capital, not because it was booming, but because money there was nearly free. Entire portfolios were built on one assumption: Japanese rates would stay low forever. But economies don't exist in isolation, and slowly, pressures began to build. Global inflation returned after the pandemic. Energy prices surged, supply chains fractured, and even in Japan, long the poster child for deflation, prices began to rise. Wages, after decades of stagnation, showed tentative growth. Suddenly, the BOJ faced a dilemma it had avoided for years: maintain ultra-loose policy and risk collapsing currency, or normalize policy and risk destabilizing the very system it had protected. For a long time, the BOJ chose delay, but markets are patient until they aren't. As inflation persisted and global interest rates climbed, Japanese government bonds began to feel mispriced. Investors questioned whether yields near zero still made sense. Pressure mounted, and eventually, the BOJ loosened its grip, allowing yields to move more freely. That's when the bond market began to stir. 10-year Japanese government bond yields climbed to levels not seen in nearly 2 decades. Bond prices fell, and suddenly, institutions that had treated JGBs as riskless assets faced losses, at least on paper. For banks and insurers holding vast quantities of bonds, this mattered. Even modest yield increases translate into large price declines when portfolios are massive. Balance sheets tightened. Risk management assumptions were tested. But the real danger wasn't just domestic. Japan is not just a borrower. It is a cornerstone of the global financial system. When Japanese yields rise, something subtle but powerful happens. Money has a reason to come home. If investors can earn more by holding Japanese bonds without taking currency risk, then the incentive to keep money abroad weakens. Capital that once flowed outward begins to reverse. That reversal can hit foreign markets hard. US Treasuries may see reduced demand. Emerging markets that relied on cheap funding may face higher borrowing costs. Asian currencies can come under pressure as yen strengthens and carry trades unwind. This is how a shift inside Japan's bond market becomes a global event. And the process doesn't need panic to cause damage. It only needs repricing. Consider a pension fund in Tokyo. For years, it accepted low yields at home and compensated by buying foreign assets. Now, with Japanese yields rising, it faces a choice: continue taking currency risk or rotate back into domestic bonds. Multiply that decision across banks, insurers, asset managers, and hedge funds, and the impact compounds. This is the invisible mechanics of global finance: slow, technical, and unforgiving. Meanwhile, inside Japan, the consequences are deeply human. For households, rising rates mean higher mortgage payments, especially for those on floating-rate loans. A small percentage change can reshape monthly budgets. Consumption decisions shift. Anxiety returns. For small businesses, cheap credit had become a lifeline. Higher borrowing costs force difficult choices: delay expansion, cut staff, or raise prices. For the government, the stakes are enormous. Japan's public debt is vast. Even a modest rise in average interest rates dramatically increases debt servicing costs over time. That squeezes fiscal space: less money for social programs, healthcare, or investment in productivity. This is where the paradox sharpens. Japan normalized policy to reflect economic reality, but in doing so, it exposes the fragility built during decades of artificial stability, and yet, doing nothing was no longer an option. If the BOJ had continued suppressing yields indefinitely, the yen could have weakened further, importing inflation and eroding purchasing power. Trust in the currency might have cracked. Capital flight could have followed. Every path carried risk. This is not just a Japanese story. It is a lesson about systems built on postponement. The United States and Europe faced inflation earlier and moved faster, raising rates aggressively. Their bond markets absorbed the shock sooner. Japan delayed longer, which made its eventual adjustment more sensitive. Demographics compound the challenge. Japan's population is aging rapidly. A shrinking workforce limits growth. Social spending pressures rise. Productivity gains are essential but hard to achieve quickly. In this context, higher interest rates are not just a monetary tool. They are a stress test. So what happens next? There are three broad scenarios. In the optimistic case, Japan manages a gradual normalization. Yields rise slowly. Institutions adapt. Capital flows. Relevance without chaos. Higher rates restore some market discipline, encourage better capital allocation, and strengthen the yen without crushing growth. In the pessimistic case, a bond accident occurs. Yields spike too quickly. Losses cascade through financial institutions. Confidence erodes. BOJ is forced to intervene aggressively, restarting massive bond purchases and undermining credibility. And in the middle scenario, the most likely one, Japan muddles through. Policy oscillates. Markets remain volatile. Growth remains modest. The world adjusts to a Japan that is no longer a permanent source of free money, not fully. Normal either. Each path carries global implications, because Japan's shift forces are broader. Reckoning. The era of universally cheap capital is ending. For decades, economies and investors adapted to a world where money was abundant and risk was dampened. Asset prices inflated, debt accumulated, structural problems were deferred. Now, normalization is exposing those trade-offs. The question is not whether pain can be avoided, but how it is distributed. Will households bear higher costs while asset holders are protected? Will governments reform spending or rely on central banks to mask imbalances again? Will markets relearn how to price risk? Japan's bond market is not just waking up. It is asking the world to wake up with it, because stability built on denial is not stability at all. And when the cheapest funding source in the world changes its mind, the consequences don't stay local. They echo through balance sheets, currencies, governments, and living rooms. The quiet shift in Japanese yields may not dominate headlines, but it marks the end of an assumption that shaped global finance for a generation, the assumption that someone, somewhere, would always keep money cheap. That era is fading. What replaces it will define the next chapter, not just for Japan, but for the world. There is one more layer to this story that rarely makes headlines, yet quietly determines how painful this transition will be. Trust for decades. Japan's financial system ran not just on low interest rates, but on an implicit social contract. Households trusted that prices would remain stable. Banks trusted that government bonds were risk-free. Companies trusted that capital would always be cheap. And policymakers trusted that time itself would solve structural problems. Low rates were not just a policy choice. They became a psychological anchor. When that anchor begins to move, uncertainty spreads faster than numbers on a chart inside Tokyo. This shift is already changing behavior. Younger workers long resigned to stagnant wages and delayed milestones are facing a new dilemma. Higher rates may finally reward saving, but they also raise the cost of buying a home in cities where housing is already scarce for a generation that postponed marriage, children, and long-term planning. Normalization arrives not as relief, but as another recalibration of expectations. For retirees, the picture is equally complex. On paper, higher yields offer something Japan hasn't seen in years: income from safe assets. But many retirees depend indirectly on institutions, pension funds, and insurers that now face balance sheet volatility. What looks like stability at the individual level may mask fragility in the system beneath. And for policymakers, trust is the hardest asset to manage. If markets believe the Bank of Japan will always step in, risk-taking resumes and distortions deepen. But if markets believe the BOJ has stepped back permanently, volatility can spiral. The central bank must convince everyone that it is serious about normalization without proving it too convincingly. This is the tightrope. Globally, investors are watching closely. not because Japan is about to collapse, but because Japan represents the final unwinding of an era. Europe tested normalization first. The United States followed with speed and force. Japan, by delaying longest, is now the last pillar adjusting, and late adjustments are rarely gentle. If capital flows reverse more sharply, emerging economies could feel pressure almost immediately. Countries that relied on foreign borrowing to fund infrastructure, housing, or consumption may see currencies weaken and debt servicing costs rise. These effects won't originate in Tokyo boardrooms, but they will be traced back there. This is how global finance transmits stress, not through intention, but through incentives. At its core, Japan's bond awakening is a reminder of something deceptively simple. There is no free lunch in economics, only deferred costs. Ultra-low rates bought time. They softened downturns. They preserved social cohesion. But they also allowed inefficiencies to persist, productivity to lag, and demographic challenges to compound. The bill was not erased. It was postponed. Now, as rates rise, that bill comes not all at once, but persistently. The real question is not whether Japan can survive higher interest rates. It can. The question is whether societies, markets, and governments are willing to adapt to a world where money has a price again. Because adaptation requires trade-offs. It requires admitting that some business models were only viable under artificial conditions, that some asset prices were inflated by policy, not productivity. That stability enforced along becomes fragility in disguise. Japan is not failing. It is adjusting late, carefully, and under immense pressure. And in doing so, it offers a preview of what many other economies may face next. A future where central banks cannot solve structural problems alone, where debt has consequences. Again, where growth must come from productivity, not leverage, and where trust must be rebuilt not in cheap money, but in resilient systems. The awakening of Japan's bond market is not a crisis headline. It is a warning signal, a reminder that economic systems, like societies, cannot remain suspended forever between fear and denial. Eventually, they must move, and when they do, the world moves with them.